welcome back to the Investing Show. Joining us now, we've got Gemma Godfrey, founder and CEO of Moolah. Gemma, welcome to the show.
Thank you for having me.
So, you've been on both sides of the world, I guess. You've worked in the investing industry for many, many years, but you've also been involved in trying to explain some of the things that goes on there to normal people. So, how do you see that from both sides? Do you think that the investing world makes things too complicated for people?
I think people in finance, to put it bluntly, don't kiss enough. And I think that's the secret, is, keep it simple, stupid. Is that what happens in the financial industry is we tend to make things more complicated than they need to be, and actually hide behind jargon and acronyms. And actually, if you want to engage people and you want to get your message across, you want to sell something, motivate people to do something, whatever it is, you need to speak in a language that's very clear and relatable, and really break down and kind of build what people are looking for and give them the answers that they need.
So, I mean, where do you think a lot of that complication has come from? Has it just built up over the years? Has it been a sort of must maintain an air of mystique so we can take money off these people scenario going on, or just a combination of everything?
Well, it's evolved. It's been an evolution. So I think when you're in an environment and you're a little bit more isolated, you tend to speak in language that others understand. And then when you need to take a step outside of that industry, quite often people forget that actually you need to speak language that everyone speaks, as opposed to keeping in the jargon. So, and because of that, that's made people in finance slightly more isolated. And we've seen that there's been so much hate against the financial industry, which has kind of been self-perpetuated. And actually, the best thing to do is to break things down and to really think about the customer. And really, if you look at the background, before the financial crisis, this was even more acute, because the industry was more about pushing products, trying to sell people certain products. And what we've now got, because the consumer, the power's in their hands, is people want solutions. They want solutions to their problems. So if you want to engage with people and talk to them, you need to speak a language that they understand. And people want to know. You've got the rise of the do-it-yourself investor. People want to know.
And so, obviously, in your past work, you were involved in basically sort of devising portfolios for people, weren't you? In wealth management and that kind of thing. So how do you go about explaining the basics of that to people in terms of, well, this is what a portfolio is, this is what it does, and this is why it matters, that you don't just put all of your money into one thing?
Yeah, I mean, the most important thing is to put yourself in somebody else's shoes. And what we tend to do is we just tend to want to sound smart. And actually, it's not about sounding smart, it's actually empowering other people to become smarter. And that's kind of what we do. And also, it's about simplifying what the portfolio actually is. A lot of the time, we've seen PPI scandals, we've seen, Madoff, for example. We've seen these scandals come about because people have invested in products they don't understand, or the fund managers obviously haven't really explained what they're doing. And so it's vital to actually be able to break it down. And that's what we do. We try and keep the portfolios very, very simple. And it's like Einstein said, if you can't explain it simply, then maybe you don't understand it. So we try and break it down and relate it to people's lives. So, this is what stocks are. This is a tracker. It's going to track the shares of the top 100 companies in the UK. Putting it into simple terms, relating it to their lives, this will help engage and actually help your money grow. It'll help it grow more than if you leave your money in a bank account. Messages like that are just much more engaging. Do you want to save enough for your children's education, or to afford a house, or that once-in-a-lifetime holiday? Making things relatable is a lot more powerful a message than talking, let's go long mining and short healthcare.
Do you factor in, or try to factor in, the sort of wider financial picture as well? I mean, very broad brush. In the 20s, you probably got no spare cash because you might have a young family and or a mortgage. 30s, you might be able to put a couple of pounds aside. But of course, as we were discussing before the break, it's a question now, of course, is that 20-year-olds, come their retirement age, they're going to be responsible for their own pension. So it's, the sooner you can start saving, the better.
Exactly. It's all about taking control now. And the early years are the most important, which is why it's so ironic that people tend to either put it off or are put off from investing, because it seems so alien and so alien to them, and not something they can relate to. So absolutely, one of the most important things is to get to understand where people are in their life cycle. Also, not just their capacity for investing, their capacity for losing money, as well as how much money they want to make. So not just their attitude to taking risks, but also their aversion to losing money. So let's just put this into simple terms. you might think, okay, I've got kind of a bit of a nest egg. It's okay, I can invest in this certain thing, and if it goes down in value, it'll be fine. But actually, if it does go down in value, you won't be able to sleep at night, because that is actually your children's education pot. That's something that you're saving up for. So the most important thing is really, truly using behavioural psychology, whatever it is, and that's what we try to do, understanding the person's personality, where they are in their life, and then putting them into the right portfolio so they get peace of mind and they get that comfort. Because the most important thing is to get people, and I think this is one of the failings of the financial industry, is how do you get people that, intelligent people, people that have money that they want to invest, doctors, lawyers, whatever they may be, doesn't necessarily mean you understand finance. And how do you get them comfortable with investing and put them into the appropriate portfolios?
Yeah.
I mean, one of the things that we encounter quite often when we write about things like this will be comments from people saying, well, I would never gamble my money on the stock market, or I'm not an investor. Or you ask people the question, you see surveys where people have been asked things, and they say, oh, well, I would invest, but I don't have quite enough money yet. Yeah. Or I would invest, but, I'm not the kind of person who's an investor. Maybe at some point later in my life I will be. How would you respond to common things like that?
It's really interesting. People's perception of what risk is really fascinating. We did some customer testing, and what we found is people were very comfortable investing in property. I mean, the UK, we love property, and people will go and buy houses, and they'll take out massive mortgages. I mean, absolutely. All you have to see is the value of their house dip somewhat, and that's it. They can't move. You can't move anywhere. You're in what you call it negative equity, but they're taking a huge amount of risk. They're taking on a lot of debt to invest, and we understand the reason why. It's bricks and mortar. People feel like, I'm not taking a risk, I can feel it. Ultimately, if you live in it as well, you're definitely getting value from it. But if you're investing in property, I can feel it, it's something tangible. And then they'll say, but I don't want to take a risk on the stock market. But as we said, property can be risky, and we've seen property prices don't just go one way. We learned that the hard way. And in stocks, you can invest in a utility company. It's a gas company. It's water. It's very steady, stable, and you can earn dividends in the meantime, which means that you're not just taking a bet on the future of the company, but actually you're able to earn a little bit of money because you get a share in their profits in the meantime as well. So it is a bit of, an education. But again, if this has been a completely alienated world and no one's sat you down and actually kind of gone through this, that's where all the misconceptions come. But it is a shame, because the most important thing is to not have all your eggs in one basket. Investing everything in property is actually, in some respects, more risky than having a little bit in stocks, a little bit in bonds, a little bit, tracking the real estate market, but nice and diversified.
Do you think there's a problem, Richard, in how we report these things? In terms of us in the media, us in the media, is it too short term? Do we talk too much about share prices going up and down on a daily or a weekly basis, and not talk about the total return, taking into account the dividends?
Because that's not a great story, is it?
No. Should we be saying, well, X company is down 10% today, but over the past 5 years it's up Y%?
Every time we have a couple of hard weeks in the market, let alone a financial crisis, those photographs of the life floor traders start popping up again, the brightly coloured jackets. The life floor hasn't existed for, 15, 20 years, but it's that kind of, that excitement, that, the Wolf of Wall Street thing, that what traders are doing and all the hand gestures and all the rest of it, as opposed to what is actually quite simple and quite boring. If you're taking a buy and hold strategy, you've made your decisions, you'll go back to those just to make sure the company's still doing what it was when you bought it. But beyond that, like a utility company, for example, just move on to the next thing and look at your overall financial picture. But there are pockets of the market which could not be. I mean, the dullest and the dourest sector of all is the utilities, because of their predictability.
Gemma, obviously Moolah is a new investing service, a new online investing service. It's in this sort of vanguard of fintech, financial startups, trying to make this easier for people. And I think there's always this great irony, actually, that it's never been easier for people to invest, but perhaps people of a younger generation, because they don't have the old-fashioned financial advisor or stockbroker or person down the bank helping them over that hurdle, are actually possibly less likely to invest, even though they're totally comfortable with the internet and they could set up an investing account and do it with the touch of a button on their phone. But the other thing that we're moving more towards is the use of passive investment, isn't it, of tracker funds. Is that something that you guys are doing as well?
Yeah, it's interesting because, I mean, to answer your first question about demographics, about young people, what's interesting is there's been a lot of talk about, well, millennials don't have money, but we've moved on so many years. Millennials, you know, they're going to make up 3/4 of the global workforce within the next few years, and you're going to see 3/4 of UK banking done online already. And if you're going to open your bank account online, you know, why wouldn't you want to manage your investments online? And it's interesting, and I agree that maybe not every demographic is going to be comfortable looking at an iPhone. It might have to be a bit bigger because of eyesight. But ultimately, the move towards technology is an interesting one because it's built to solve a problem. You know, and that's what's great about it is, you know, if people want to do things on the go or they want full transparency, whatever it is, technology can build it. But in terms of, you know, coming on to your second question, which was...
It was surrounding the use of passive investment.
Passive investment.
Whether, you know, using tracker funds rather than active management. Is that a route that you guys are going down?
Yeah, the use of passive investments chimes really nicely with simplicity and low cost. So again, the starting point, instead of the starting point being what can we sell to people, which it does, you know, that's a hard thing to do. It's what are people actually looking for? And what we find is, especially when you're starting off investing and you want to start to get comfortable, the most important thing is that you can start with a smaller amount. And as even Warren Buffett says, even the biggest, you know, the world's most famous active investor says, you know, fees are one of the biggest eroders of returns. So the good thing about passive investments is the fact that they're low cost. So straight away, you can get very broad, diversified investments that are easy to understand, as we said, tracking the top 100 stocks of, you know, the shares of the top 100 companies in the UK. So very easy to understand, very liquid, so you can get your money out quickly, transparent, you know, all these things that tick certain boxes. And it allows people to take that first step. You know, for as little as a couple of £100, they can get a good portfolio, they can test it out, try it out, and then that gives them the confidence to, you know, move further forward.
I mean, is the other advantage as well that it limits their opportunities for making mistakes? I suppose. You know, the problem with... So, you know, I've read all the arguments about why you should invest passively. Totally buy into them. Okay. Yet still I believe that I'm the person who could beat the market. I'll go buy those individual shares and go pick those funds. And inevitably, some of them turn out to be duds. And I guess that by using a very simple, broad tracker and looking, instead of trying to go picking winning fund managers or picking individual winning shares, looking at asset allocation and how you're tilted towards your view of the world and you know, worrying less about trying to pick those winners, that you then limit the ability to make mistakes by not picking the winners and picking losers.
But it's also to do with there are two things. First of all, we're talking about a different audience, and secondly, we're talking about a different solution. So if we talk about the audience, people that know exactly what they're looking for, that understand, I'm not going to name names, so I understand this fund manager, I understand what he does, I think he's great, I can analyse his track record, I can look at the tracking error, I can look at his, his volatility, all these different things. People that have that knowledge and that understanding, that confidence, they can go to a broker and they can buy things directly. That's a slightly different audience from the one that we're talking about, which is the millions of people in the UK that don't have the time, or they don't have the time. They want to do investing themselves. They have that motivation, but do they want to monitor and pick the specific investments within that? Maybe not. They are looking for some guidance. I mean, it's what the regulator calls the advice gap. The fact that, as you said, people can't get free financial advice anymore. The fact that even to get financial advice, you need a minimum of £50,000, although it's creeping up. The fact there's almost one financial advisor for every 3,000 people. So there is this guidance gap. So that's the type of audience we're talking about here. It's not the people that are looking for, that know what they want to buy and are looking to trade. But also, if you talk about this is a different solution. This is the enabling people to sleep well at night, looking at long-term goals, making sure that actually they're looking after their financial well-being. And if they have that sorted and they have the main core of their portfolio sorted, then actually it enables them more to be able to then pick stocks around it, as opposed to having all their eggs just invested in one stock and wake up every day on a knife edge wondering if it's gone up or down.
Excellent. And finally, the deadly question. If you had one tip for those people, what would it be? I'm going to cheat here because it's two tips. The first tip is start now. The most important years are the early years. It gives your money longer time to grow. And the second one is if you don't understand something, then don't invest. So, really try and empower yourself with greater understanding and educate yourself on the investment options out there.
there are more than you think.
Thank you very much. Gemma, thank you for joining us. Richard, thank you for joining us. Thank you for watching. Join us next time on The Investing Show. Goodbye.